Most franchise owners are overpaying the IRS and they don't even know it. We helped one client save $27,000 in taxes in a single year by just changing one thing about their entity structure. Today we're talking about one of the most powerful and underused tax strategies for franchise owners, electing S-Corp status. S-Corp stands for S Corporation. And it's not a loophole, it's not aggressive, it's a legal IRS filing that you can make that can help you save thousands of dollars a year in taxes if done right. But here's the key. Switching to an S-Corp is just the start. There's a right way to do it and there's a wrong way that can get you in trouble with the IRS. Let's break it down. How does an S-Corp actually save you money? So step one, you would form a business, either an LLC or C corporation. They both can elect S-Corp status. And then you'd file Form 2553. This is saying to the IRS, hey, I want to be an S-Corp for taxes. And then step three, as an S-Corp owner, you would start to take a salary, and instead of what's called the self-employment tax of about 15%, hitting all of your business profits, you're only going to pay that self-employment tax on the salary piece of your income. So the remaining profits that you earned don't have the 15% tax applied. Here's what this looked like for one of our franchise owner clients in the home services space. Net income of about $180K, and with that they were paying about 27 grand in self-employment taxes. But with the S-Corp election, that quickly changed. Instead of paying 15.3% on everything, they only paid 15.3% on the salary piece. Now, we found out for them that a reasonable salary was about 80 grand. So they started to save 15.3% on the remaining 100 grand, or just over 15 grand in taxes. Again, in 1 year. Imagine over the 10-year term, if this stayed about constant, they would save about 150 grand over the term of their franchise. We worked with another franchisee that had been working as a sole prop for years. Their CPA had never suggested an S-Corp. After reviewing their financials, we made the S-Corp election mid-year, set up their payroll, and implemented a reasonable compensation strategy. With everything structured properly, from salary to distributions to expense tracking, we were able to save our client 27 grand in a single year. And again, over a 10-year term, if that stayed constant, they're saving over $250,000 in taxes. This client told us, no one had ever explained it to me in a way that really made sense like this. I always assumed that S-Corp was for big companies, not small franchise owners like me. And we hear that a lot, and that is absolutely not true. The strategies that we go over, even though you might see big companies using them, they absolutely apply for you too. And that's what our focus is making sure that you guys as franchise owners know what's available to you to cut your taxes down as much as possible. So let's clear up a few common myths about S-Corps. Myth number one, you need to be making millions of dollars for it to help you. As I just mentioned, not true. Even if you're making 50, 60, or 70K in profit, you can still save thousands of dollars a year by using S-Corp strategy. Myth number two, they're complicated and expensive. Not really. As long as you have the right systems, your payroll, bookkeeping, and compliance are all airtight, it's really smooth and affordable. And myth number three, it's a red flag for audits. That is not true at all. As long as you follow the IRS guidelines and don't get cute with your salary or how you document things, it's not an issue at all. Now, what are some common mistakes to avoid with the S-Corp filing? Now, just filing the S-Corp election isn't enough. Here's where people mess this up. One, they don't run payroll. As I've mentioned a couple times, for the S-Corp strategy to work, you have to start to take a salary, and it has to be a reasonable amount. Mistake number two is making your salary too high or too low. Again, it has to be what the IRS calls a reasonable amount. So we actually use specialized software to figure out, based on where you are in the country, the state, and the county, based on what you're doing on a day-to-day basis, as the owner that's operating in your business, what would be a reasonable amount to pay yourself. That software comes with a report to back up the amount. So in the rare event that you received an audit, you'd be able to say, look, I have a report to back up what I'm paying myself. Mistake number 3 is sloppy books. You do not want to let your books fall behind. You want to keep clean books, a separate business account, and track your distributions consistently. This way you won't run into any issues when it comes to your record keeping. Mistake number 4 is forgetting compliance. So that means your annual taxes are being done, your payroll tax returns are being done, even if it's just you. S-Corps are a great tool to reduce your taxes, but only when they're used properly. So if you're a franchise owner earning over $60K in profit and not using the S-Corp status, you're probably giving away thousands of dollars to the IRS. As I mentioned before, one of our clients saved 27 grand with just this strategy in just a single year. But remember, the S-Corp is just the foundation. To really maximize it, you need proper payroll, smart tax planning, and rock-solid compliance. Want to know how S-Corp can help your franchise? Well, if you're not using an S-Corp, and even if you are, drop a comment below. We'd love to hear your questions. Is there anything that you're either confused about in the video or anything else that might be going on? And we'd be happy to get in touch with you. And subscribe for weekly franchise tax tips that keep more money in your business and out of the IRS's hands.